Welcome to Property Report UK, your trusted source for clear, independent analysis of the British housing market. If you care about what's really happening behind the headlines, not just the glossy estate agent optimism, but the structural risks shaping your home's future value, you're in exactly the right place. Tonight, we're examining a story that feels almost unthinkable. It's 2026. You're 64 years old. You've worked for more than 4 decades, paid your taxes, raised your children, and sent your mortgage payment every single month without fail. For 25 years you've transferred money to one of Britain's major lenders, perhaps Halifax, NatWest, Barclays or Santander UK. You never missed a payment. Not once. You decorated the spare room when your first grandchild was born. You landscaped the garden. You replaced the boiler. You thought quite reasonably that you were buying your home. Then one winter morning, a letter arrives. It carries your bank's logo. You assume it might be confirmation that the mortgage term is nearly complete. Instead, it states in plain, clinical language that your 25-year mortgage term has expired and the remaining capital balance, perhaps £200,000, is due within 30 to 60 days. You call the bank, confused. You've paid for a quarter of a century. Surely this must be an error. But the answer is devastating. You had an interest-only mortgage. For 25 years, you've been paying only the interest. The original capital, the full £200,000, remains outstanding. And now the bank wants it back. This is not fiction. It is the reality facing a significant cohort of borrowers whose loans, arranged in the early 2000s, are now reaching maturity. And it is what many analysts are calling the 2026 interest-only mortgage cliff edge. To understand how we got here, we need to go back to the credit boom of the late 1990s and early 2000s. House prices were rising rapidly. Confidence was high. Lending standards were looser than they are today. Property was widely viewed as a one-way bet. At the time, interest-only mortgages were not inherently unsuitable products. They were designed for borrowers with credible repayment strategies, investments, savings plans, or planned downsizing. Monthly payments were significantly lower than traditional repayment mortgages, because borrowers were only servicing the interest on the loan. The pitch was compelling. Why stretch your budget to pay £1,400 a month on a repayment mortgage when you could pay £700 on interest only and let the property growth do the work? Many were also sold endowment policies, which were expected to mature and repay the capital at the end of the term. But the assumptions underpinning those strategies were optimistic. Investment returns fell short. Some endowment plans underperformed dramatically. Meanwhile, although property prices did rise over the long term, they did not rise evenly, and crucially, downsizing is no longer the straightforward solution it once appeared to be. Today, a home purchased for £200,000 in the early 2000s may indeed be worth £450,000 or £500,000. On paper, that seems reassuring. Sell, repay the £200,000 capital, and retain the difference. However, the retirement bungalow or small flat you once imagined buying for £150,000 has also risen sharply in value. In much of southern England, £300,000 barely secures a modest one-bedroom flat. Stamp duty, moving costs and legal fees further erode the remaining equity. The arithmetic is no longer as comfortable as it once seemed. And then there is the refinancing problem. Following the financial crisis, regulators tightened lending rules considerably. The Financial Conduct Authority introduced stricter affordability tests under reforms commonly known as the Mortgage Market Review. Lenders must now assess income, stress test repayments and consider age at the end of the term. For a borrower in their mid-60s, extending a 25-year mortgage becomes extremely difficult. Pension income often does not meet modern stress testing criteria. The result is what industry insiders refer to as mortgage prisoners, borrowers unable to refinance, yet unable to repay the capital outright. If repayment cannot be arranged, the legal process begins. The lender may seek possession through the courts. In many cases, the contractual position is clear: the capital is due at term end. Judges have limited discretion if the agreement is unambiguous. When properties are repossessed, banks do not behave like patient private sellers. They appoint Law of Property Act receivers, whose primary duty is to recover the outstanding debt. That can mean a quicker sale, sometimes at auction, to secure funds efficiently. While lenders must aim to achieve market value, the dynamics of forced sales can place downward pressure on realized prices. Here is where the broader market implications emerge. The UK still has hundreds of thousands of interest-only mortgages outstanding, though the number has declined steadily over the past decade. A concentration of maturities between 2026 and 2028 raises legitimate questions about localized supply shocks. If multiple properties in the same postcode are sold under time pressure, comparable valuations may soften. Property markets are heavily influenced by comparable sales data. Surveyors rely on recent transactions when assessing value. A cluster of discounted sales can reset expectations. That matters not only for those directly affected, but also for neighbors looking to remortgage or sell. However, it is important to maintain perspective. This is not 2008. Banks are significantly better capitalized than they were before the global financial crisis. Arrears rates, while rising modestly in certain segments, remain well below crisis levels. Many borrowers approaching maturity have already taken action switching to repayment, making partial capital reductions, or planning voluntary sales. There are also options available, though none are painless. Some lenders are willing to consider term extensions on a case-by-case basis, particularly where borrowers engage early and demonstrate a realistic exit plan. Others may offer retirement interest-only products, where monthly payments continue but capital is repaid upon death or entry into long-term care. Equity release is another route, though it requires careful consideration. Lifetime mortgages allow borrowers to remain in their homes without monthly repayments, with interest rolling up over time. The trade-off is reduced inheritance and the compounding effect of interest. It can be a solution, but it is not a decision to take lightly. Perhaps the most pragmatic strategy for many is proactive downsizing. Selling voluntarily, before enforcement action begins, gives homeowners control over timing, presentation and negotiation. Achieving full market value rather than an accelerated disposal can preserve significantly more equity. The central lesson here is engagement. Ignoring correspondence is the worst possible response. Under current regulatory expectations, lenders are required to treat customers fairly and consider vulnerability. Early communication can open doors that close rapidly once legal proceedings commence. For younger viewers, this story is not merely a cautionary tale from another generation. Housing markets are interconnected ecosystems. A rise in forced sales can influence price growth trajectories. Shifts in older homeowners' equity positions can affect inheritance flows, consumer spending and even political pressure for regulatory change. For policymakers, the question is delicate. Intervene too heavily, and you risk moral hazard. Fail to intervene, and you risk hardship concentrated among retirees who believed, perhaps understandably, that time and rising prices would solve the problem. At Property Report UK, our role is not to inflame panic but to illuminate risk. The interest-only maturity wave is real. Its scale will vary region by region. Its impact will depend on interest rates, employment conditions, and lender forbearance policies over the next 2 years. If you or your family hold an interest-only mortgage approaching maturity, the key message is this: review your paperwork now. Understand your repayment vehicle. Obtain a current property valuation. Speak to your lender before the final year of the term. The earlier you act, the more options remain on the table. For the wider market, we will be watching closely. Auction volumes, repossession statistics and regional price adjustments will tell us whether this becomes a contained adjustment or a broader correction. That's all for today's in-depth report. If you found this analysis useful, make sure you subscribe to Property Report UK. We cut through the noise to bring you clear, independent insight into the forces shaping Britain's housing market. Give this video a like to help more viewers discover balanced property journalism, and share it with anyone who may be affected by an interest-only mortgage approaching its end date. Stay informed, stay prepared,